A rip-roaring equity market rally meets gravity. Live from New York City this morning. Good morning, good morning. Equity futures down 0.75%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Fed Chair Jay Powell set to confront stronger data, President Biden gearing up to address the nation, and Wall Street banks pouring cold water over this year's rally. We begin with the big issue, from hard landing to soft landing to maybe no landing at all.
This isn't a choice of soft versus hard landing.
Look at the labor market. This is yet again a soft landing type of report.
520,000.
Undoubtedly a strong number. Still going to be an issue for the inflation outlook.
We see some dynamics for inflation to persist.
Whether or not inflation ends up being unhinged and ends up not coming down the way we forecast.
We have seen very mixed signals.
The soft landing.
I hope the Fed engineers a soft landing.
The markets like to hear the Fed chair talking about a soft landing.
It's always a soft landing until it isn't, until it's a hard landing.
It's a soft landing until it becomes a hard landing.
Joining us now to discuss Invesco's Matt Brill, Aberdeen's James Athey. To you, gents, thanks for being with us. And let's start with that quote. This quote right here from Apollo's Torsten Slog, who says this: "It's beginning to look more like a no-landing scenario. Under the no-landing scenario, the economy does not slow down, and upside risks to inflation are coming back after the initial decline in inflation driven by supply chain improvements." I want your opinion on that, Matt Brill. Could we face, after that payrolls report from Friday, a so-called no-landing scenario this year?
Hey, good morning, Jonathan. Yeah, we've been in the soft landing camp for quite some time. I have not even heard of this no landing until Friday, I guess. But I'm still staying with soft landing. I think it was a bit of an anomaly, a little bit of a blow-off top. We got an employment report for the month of January. But at the end of the day, the data has been very clear that the economy is slowing. Everything but the labor force is slowing. Inflation is slowing. We're looking at inflation for the last 3 months that have trended less than 2% for headline, around 3% for core. So put it all together, this economy is slowing, but yeah, the labor market still is remaining very, very hot.
Chairman Powell said the disinflationary process had started last Wednesday. James Athey, do you think the jobs report on Friday contradicts that, or do you think it reinforces it?
Yeah, hey John, I don't think it reinforces it. It's certainly what we know about the labour market is that it's one of, if not the most lagging of indicators. It really does occur to me that the inconsistency of the data to some degree is reflective of just what's forward-looking and what's backward-looking, and certainly the jobs market is lagging, and this goods services rotation post-pandemic and reopening that we have seen, I think, really is the tail end of the kind of pandemic disruption. So I still think there's plenty of justification in thinking about the jobs market data as having been stale, but you can't really. It's very difficult as an investor to pick too many holes in that as we sit here today, because it was such an incredibly strong-looking report, then backed up with that ISM services. So I'm not in the soft landing camp. I think if there's a recession, it's never a soft landing. If you go back to 2006-07, you can see quotes from the Fed talking about a soft landing, and obviously that was hopeful. But I have to say, this new data, just at the margin, softens the sort of conviction in that view.
Well, James, to your point, it wasn't just payrolls. It was the ISM services read as well. That bounced back aggressively, up something like 6 points, the largest bounce we've seen in the ISM non-manufacturing survey going back to the middle of 2020. And I think at the moment you had this tug of war between the bears and the bulls, the people who thought we were going to have a recession, those that thought this expansion could continue. And the two things that they'd point to, James, they'd say sub 50 ISM, not great. They'd say, look at the labour market report. Hours worked. It's coming down. It's not increasing. Then on Friday, big bounce in the non-manufacturing survey. New orders absolutely surged. And within the labour market report, hours work actually increased, James. How do you make sense of that?
Yeah, I was thinking about what I would say to you, and the back and forth, I was going to call it narrative tennis. I very much think that there are, broadly speaking, two views of the world, and depending on what day and what week it is, data is supportive of one versus the other. And so here we go back and forth. So I totally agree. The ISM, I'm amazed we haven't talked about the weather more. We had that horrible cold snap in most of the northern United States, going all the way down to Texas and Florida. And it was around the time they would have been surveying for previous months' ISM services. I think there was a lot of weather disruption in there. I expected to see quite a big bounce back. It was bigger than I expected. But again, for now, I'm going to net those 2 months and say that there's a lot of disruption. I want to see more data. Remember that the PMI services does not in any way support the ISM services, and indeed the ISM manufacturing tends to suggest that the direction of travel for the ISM services is lower. So again, there's still plenty of data to support whichever narrative you choose. The jobs market, on the face of it, difficult to pick holes. But again, you look at the bed data that the Fed produces themselves, where they take the BLS underlying data set and they do slightly different things from a statistical basis. And that told us this last week that jobs are overstated by 1 million just in the second quarter, by looking at headline NFP, which supports the idea that the household survey has been telling us jobs growth is a little bit weaker. I'm a little skeptical still as to the extent of the robustness of the labour market, because you've seen 50 and sub 50 in the employment components of both ISMs, and the broad data set raises some questions. But again, as an investor, I can't really bet the farm on that here today, because the prevailing narrative does have some very recent data to support it, yeah.
James, to your point, though, the fact that we're playing narrative table tennis every single day and it's going from one thing to the other, I just wonder, Matt, if there's something to learn from that we're absolutely clueless about the post-pandemic labour market realities. Are you convinced? Do you have anything to say about where we are post-pandemic in this labour market? Do you have any confidence about the trajectory of things?
Yeah, I mean, you're absolutely right. There's a lot of confusion around the report. There's a lot of misunderstanding of what a post-pandemic labor market's supposed to look like. But at the end of the day, what we do know is the economy is slowing. Now, whether or not the labor market's slowing, that's certainly debatable. The economy is slowing. We do believe inflation's coming down. The Fed probably wasn't thrilled with that report on Friday, but honestly, a lot of the other data we've been seeing supports the narrative of this disinflation, which he spoke of over and over on Wednesday. So, I think these numbers have a lot of noise in them. Molly Smith had a great Bloomberg article out for you guys last week on kind of explaining some of the anomalies there. If people haven't read it, I think they should. But at the end of the day, things are slowing, and that's what we've got our hat held on right now.
Well, this market's moving big time off the back of that data. It continues this Monday morning. Equity futures are down 0.7%. They're moving the 2-year. We started the year at about 440 on a 2-year, got as low as 4.03% intraday just in the last week or so. Now we're back to 442 on a 2-year, with yields higher by 13 basis points, and all of that ahead of Chairman Powell speaking tomorrow. Mike McKee, a big one for Chair Powell tomorrow.
Yes, indeed. Narrative tennis. I like that. Narrative table tennis, you called it. I think both of you are kind of way behind the curve on Wall Street these days. It's narrative pickleball.
Oh, there we go.
So that's what you got to call it.
Forgive us.
Markets are trying to wrap their heads around what happened on Friday with the jobs report, and that ISM services number seems to be changing the narrative that investors are invested in. The Fed is essentially at its terminal rate and will have to cut rates later this year as the economy slows too much. You can see what the Bloomberg Economist survey going into the jobs report said. We would have 1 quarter of really weak growth, then 2 quarters this year of contraction, followed by another weak ending quarter for 2023. As the bond market shows and the stock market futures show, there's a big rethink underway right now. If job growth is strong, and as John mentioned, hours worked are rising, that's a lot more money in consumers' pockets available to spend. And at least according to the Fed's Phillips curve model, that means inflation will be stickier. You can see the result here. The forecast for next week's CPI and retail sales reports stronger than expected, stronger than they have been. Now, what threw market participants on Wednesday last week were Powell's comments that, yeah, the Fed expected to raise rates and keep them there, but maybe if inflation came down faster than they thought, the markets might be right, and that was okay with them. They expected him to be a lot more hawkish, to push back on loosening in financial conditions. So he gets another chance tomorrow when he sits down with David Rubenstein, the host of Bloomberg TV's David Rubenstein Show at the Washington Economics Club. I'll be there for that. The jobs report seems to have changed the narrative. Does he change his story at all? Lots of other Fed speak, too, that we need to pay attention to, because Powell is the most important, but not the only one. You got Barr, Williams, Cook, Bostic, Kashkari, Waller, and Harker, and they'll all be playing narrative pickleball.
Can't wait, Mike. Can't wait for that. The obsession with pickleball in New York. You see that on a Saturday morning?
I watched it for the first time on television.
What did you think?
It reminded me of badminton.
It now airs on TV. That's
it's
incredible stuff. Yeah. Okay, let's see how long we play that for. Mike, thank you. Matt Brill, Chairman Powell, if he had that report on Wednesday from Friday, do you think Wednesday would have been any different?
Yeah, I think he would have definitely been a little bit more hawkish, without a doubt. I think, he basically said, all right, you guys want to play data dependent? We'll play data dependent. And guess what? The data was really hot. So, he's kind of giving the market what they want, which is at this point just saying, I'm not predetermined on where I'm going with this. And I think that's good, because for all last year, he was saying we're getting to 5% and we're sticking through 2023. And then that's where we're going to go. Now he's saying, well, let's just see where how this plays out. And, you've already priced in a May hike from Friday's data alone. So to me, that just shows the market's going to be at the mercy of the data. And that's all right, because I'd rather be at the mercy of the data than just the Fed saying, here's what we're going to do no matter what, which is kind of what they were telling us the back half of 2022.
Begs the question, James, how well understood the reaction function of the Fed actually is. If you look at the price action over the last couple of days, you could make the argument that maybe Chairman Powell doesn't have work to do tomorrow. Lisa and I were talking about that earlier this morning on Bloomberg Surveillance. Yields are up off the back of strong data. Isn't that what the Fed chair would like to see? Does he need to validate that tomorrow?
No, you're right. I mean, I'm, as a general rule, pretty critical of central banks, but I have to say I think the Fed's, since they recognise the kind of error of keeping policy way too easy for way too long, I think they've actually done a really good job. Communication has been consistent from speaker to speaker, and they've not been afraid to be forceful when it's necessary. As you get to this stage towards the inflection, it becomes a bit more nuanced. And remember, the Fed has been very clear about the fact that one of the inputs into its decision-making is the accumulated tightening thus far. And we've not seen really new evidence of that just in the last day or in the last week. Obviously, that's still an additive process happening all the time. And so we should expect to see that increasingly in the data. I don't think that the data we saw Friday really changes much for the Fed when they look at the March meeting. I don't think they're going back to 50 basis points. I think the bar to that is incredibly high. So it solidifies the idea they hike 25. Is it impactful for May policy setting or June or beyond? Not really, because we're going to get a lot more data between now and then. So the fact that the market has just nudged up the front end makes some sense. I would question whether the curve should steepen on that outcome, because to me it does raise the potential for a soft landing, even though it's not a base case. But risk has come down, financial conditions have tightened. To your point, does he really need to pile on at this stage? I would suggest probably not.
Well, let's talk about financial conditions. Matt Brill, if you look at high yield spreads, they're 200 basis points tighter than the wides of last year. If you look at the equity market, take the NASDAQ, it's 15% higher year to date. If you take the dollar, it's about 10% weaker from the peak at the back end of September. Matt, how can the Fed chair say financial conditions haven't moved much since the last Fed meeting?
Yeah, they absolutely have. And even just last week alone, you saw triple C's really outperforming, because everybody thinks if you have a soft landing or a no landing scenario, triple C's will do extremely well. So credit spreads, high yield, they broke through 400. That's certainly telling you that the economy is going to do well. Investment grade spreads down I think it's 108 on the credit index, maybe 115 depending on other indices that you look at. That certainly, while not rich, it's by no means pricing in any kind of recession. It's not financial conditions tightening at those levels. So the Fed is going to have to talk this back a little bit if that's what they want to focus on. But they had the chance, and that was what was so peculiar about Powell last week, is he had the chance and he didn't take it. So he seems as if he's okay with it for now.
Well, for some, it was a green light to add more risk. Now, Matt, I just wonder whether it's rich relative to what you expect in this economy. We've had a massive rally. Is it too rich?
So we don't think it's too rich, because people are looking at all-in yields. And, we get focused on spreads, and that's really what historically we've done. All-in yields look cheap, and the technicals are just so overwhelmingly positive as the inflows come in, that I think that this is going to be a little bit of a buying opportunity on any kind of backup you get. If people say, well, I missed it at 5%, and now it goes to 5.15 on credit yields, whatever they're looking at, they want to buy more. And the inflows are certainly nonstop right now.
The inflows are huge. James, I just wonder, never mind fundamentals. This was a story we talked about over the last week, just positioning the flows. Fighting that just seems really difficult. I know yields are high today, but is there just this wall of money just waiting to come in and just buy it in fixed income?
I mean, well, the answer to that question, we'd be here for hours, because I do think that that's just the way that the market operates now. It has become this momentum machine. This is not just about credit spreads. It's not just about equities or equity sectors, but you're seeing it in bond markets as well. The worst performers of yesterday become the best performers of tomorrow, to some degree, regardless of fundamentals. Short-term positioning swings so dramatically from one side to another. Short bases build up, and we just can't climb that wall of worry, if you like. And so we swing back the other way, even if really economic fundamentals are not justifying it. I think the move we've seen in equity and credits, and it's not a huge surprise to me as a miserable old rates guy to slightly disagree with Matt, an IG guy there. I get that a lot internally. But yes, all-in yields look attractive. But if the more attractive component within that all-in yield is the safe yield, the government yield, because we're going into recession, I would still argue that would be favourable from an asset allocation perspective. But the reality is that a lot of these cyclical assets have been to some degree underowned, and fixed income in general, when you look at the big pots of money, the big asset allocators, fixed income in general has been underowned. Money just coming back into those markets over time, of course it's going to squeeze a short-term short base.
Well, let's see if that backup in yields this morning gets bought. James Athey, Matt Brill sticking with us. Coming up, the balloon controversy stoking geopolitical tensions.
On Wednesday, when I was briefed on the balloon, I ordered the Pentagon to shoot it down on Wednesday as soon as possible.
We'll catch up with Anne-Marie down in D.C. up next.
On Wednesday, when I was briefed on the balloon, I ordered the Pentagon to shoot it down on Wednesday as soon as possible. They decided, without doing damage to anyone on the ground, they decided that the best time to do that was if we got over water outside within 12-mile limit. They successfully took it down.
The US shooting down a suspected Chinese spy balloon, stoking tensions between the two nations. Secretary Blinken defending the action after postponing his trip to Beijing.
Any country that has its airspace violated in this way, I think, would respond similarly. And I can only imagine what the reaction would be in China if they were on the other end.
China slamming the move, calling it an overreaction. The foreign ministry saying this: the Chinese side clearly requested that the US appropriately deal with this in a calm, professional and restrained manner. For the US to insist on using armed force is clearly an excessive reaction. This is President Biden prepares to deliver his State of the Union address tomorrow. Let's catch up with Bloomberg's Anne-Marie down in Washington for more. AMH, are we going to talk about this for the next couple of days or maybe even the next couple of weeks?
I certainly think so, Jonathan. There's no way the president is going to be able to not address the surveillance balloon that they successfully shot down over the weekend in his State of the Union address tomorrow. Here in Washington, D.C., the administration is getting hammered by Republicans for not shooting it down earlier. But you heard the president there speaking to reporters over the weekend. He said he wanted it shot down on Wednesday, but he took the advice of the Pentagon and some of the risks that they had outlined. But, Jonathan, what we can say about the State of the Union is that this is going to be one issue the president will likely address when it comes to China. There are a number of issues. Senator Mitt Romney took to Twitter talking about the fact that there is this surveillance balloon in the sky, but there's millions of TikTok balloons on individuals in America's mobile phones. So the president is likely going to have to address a number of issues when it comes to China, how he doesn't want to be in conflict with China, but they want to make sure that they are outlining whether it's export controls, tariffs, etc. When it comes to the balloon, a number of questions remain. What were the spying capabilities? Will the payload be able to offer the U.S. intelligence services some of those details? Secondly, were any U.S. companies involved in terms of their technology that the Chinese had used on the balloon? And third, Secretary Blinken did not cancel his trip. He postponed his trip, and there's a growing course for him to get on a plane and go to Beijing sooner rather than later to condemn these actions and also, Jonathan, point to the fact that the U.S. believes Chinese companies are quietly helping Russia in their war effort in Ukraine.
Brilliant reporting, Anne-Marie, as always. Looking forward to that coverage over the next couple of days. AMH there down in Washington. Matt Brill, James Athey back with us for more. James, let's talk about China. Not so long ago, maybe about 12, 18 months ago, China was so-called uninvestable. We started 2023, all of a sudden it was unavoidable. What is it now?
That's a good question. Yeah, it's definitely complicated the macro outlook. Investing in China has always been a somewhat different ballgame. You just have to look at the period post China's entry into the WTO. The spread of GDP growth between China and the rest of the world was in no way reflected in aggregate equity performance over that period. You had an economy growing initially at 14 or 13% annualized, but ultimately over a 20-year period, Chinese equities went pretty sideways. So the investing story is as much about understanding domestic behaviors, domestic policy making, as it is the economy. And so that's a complicated question. I think the Chinese government bond market is already pricing a fair amount of economic weakness and or monetary easing. So I'm not sure there's an obvious trade there. But in terms of what Chinese growth improvement means for the global economy, is it the sort of boost we saw 2015-16 or post the crisis in 2008? Is it going to boost commodity prices, boost German manufacturing, boost Australia in terms of trade, etc.? Yeah. Is it something more domestic and consumer driven? I certainly err on the side of the latter. I don't think the Chinese economy is the same or will plug into the global economy in the same way as it has historically. But from a sentiment perspective, it's certainly adding to the potential inflationary forces via higher commodity prices. And of course, that is a complication for central banks in the Western world.
Matt, you get the final word, please.
Yeah, we think for China, it's an opportunity. Last year it got to a point where it was, uninvestable, but as the government came out and really laid down the groundwork, particularly for the Chinese property companies, that's just completely opened up that market. They're going to be supportive of it. You've seen names like Country Garden go from 15 to 85, 90. These are not necessarily household names, but they're certainly the biggest of a complicated sector over there. So for us, that's an opportunity. But at the end of the day, you need China to open up to drive inflation lower, but you also have the conflicting part of that with the higher commodity prices. But we think net, a strong opening up of China is good for the overall global markets.
There's so much we don't know about the year ahead. Matt Brill, James Athey, to the both of you, tremendous, thank you. Equity futures down about 0.7%. Coming up, the morning calls and later, Wall Street sounding the alarm on the rally after some monster gains in January. That conversation still ahead with Jay Pawlowski. 4 minutes from the opening bell, let's get you some morning calls. First up, Raymond James downgrading PayPal, a more cautious stance after the stock's outperformance this year. Whilst Fargo upgrading Spotify, looking for a boost to the company's margins on music. And finally, Wedbush raising its Tesla price target to $225, expecting demand in China to continue improving. That stock is up by 1.9%. Coming up, JP Morgan, Morgan Stanley, Goldman, all calling time on the equity rally. That conversation up next with TPW's Jay Pawlowski. 23 seconds away from the opening bell this morning. Good morning. Let's get this trading week really started. Equity futures down 0.6% on the S&P. On the Nasdaq, losses Friday. The losses spill over into Monday morning. The Nasdaq 100 down by 0.9%, following a blowout payrolls report on Friday and going into Chairman Powell tomorrow. There's the opening bell. Switch at the board and get to the bond market. Big moves. Yields higher by 10 basis points on a 10-year to 362.31. Bigger moves at the front end. We're back through 440 on a 2-year. Your 2-year yield higher by 14 basis points to 442. That means dollar strength. Euro dollar 107.54. Bear in mind the high of the year on euro dollar was only last Thursday at 110.33, and right now 107.54. In the commodity market, close to 74, up by 0.8% on WTI, $74 and a couple of cents. One stock to watch at the open, it's Dow, cutting roughly 5% of its global workforce as it experienced market conditions that, according to a memo from this co-COO, quote, continue to erode with an uncertain future. Abby has more. Hey, Abby.
Hey, John. Well, yeah, another tech company here biting the dust. Dell cutting more than 6,600 jobs, as you mentioned, about 5% of the global workforce. And after this takes place, they will have the lowest global headcount going all the way back to in more than 6 years. And what makes it so interesting is exactly what you're talking about. This is not a matter of having overhired during the pandemic. They're seeing a tough environment. The PC buying slowdown really hitting the company. That's a bulk of their business, more than 50%. Now, what's interesting is this stock over the last year really underperforming the sector. Dell over the last year down about 28%, the hardware sector down about 10%. Making this very, very interesting is it's not just Dell that is seeing the slowdown in PCs. It's not as though folks are banning Dell PCs and going toward HP. PCs overall are really sliding down about 28% in the fourth quarter. But maybe investors think that the company has less diversification in terms of their majority revenue going toward PCs and less to lean on in the future. Right now, the stock down about 1.3%. It'll be interesting to see if it stays down or if it turns around, as so many of the others have turned around, in the idea that the worst is over.
Abby, thank you. About 2 minutes into the session, equities lower by 0.4% on the S&P. No real drama here. We'll see if this weakness gets bought. On the Nasdaq, we're down by about 6 or 0.7% off the back of the weakness on Friday, but still Friday. We closed out the week with a 5th straight week of gains. I keep going back to the bond market. Keep an eye on things at the front end of the curve. Higher by 12 basis points to about 441 on a 2-year. Tons of people responding, reacting to the payrolls report on Friday. This from Mike Gapon of Bank of America, who published just moments ago. Here's the quote for you. The January employment report does not change our view of the labour market. It's still resoundingly strong. He goes on to say the report gives us more confidence in our outlook for 2 additional 25 basis point hikes and a terminal rate of 5 to 5.25. That from Mike Gapon of B of A, literally about 30 minutes ago. Another stock to look at, it's Tesla, raising prices for select US models after the Biden administration expanded the number of EVs that are eligible for tax credits. Elon Musk taking to Twitter, writing this: the last 3 months were extremely tough. Had to save Twitter from bankruptcy while fulfilling essential Tesla and SpaceX duties. Wouldn't wish that pain on anyone. Twitter still has challenges, but it's now trending to break even if we keep at it. David Welsh joins us now from Detroit, not on Twitter, but on Tesla. David, make sense of what's happening with price cuts and then price hikes.
Look, you're going to see a lot of volatility right now in vehicle pricing, which I'll explain in a second. But in the case of Tesla, I think guidance on the Inflation Reduction Act and what vehicles will be eligible for those incentives is playing a big role here. What they essentially said is SUVs, crossover SUVs, can now be eligible for, at a higher price point, they can be eligible for these full tax cuts. So I think Tesla's pushing in something there that'll account for that. There's also a chance that they may have seen a lot of demand after those very steep price hikes, and the Model Y got as much as 20% of a cut. So they may have seen a lot of demand and realized they could sneak a bit in there. But on the macro, okay, we saw used vehicle prices, I'm not just talking Tesla, but all vehicles, drop 15% in December. They've all of a sudden ticked up a bit in the first 2 weeks of January, and I think they're going to come up a bit more. So there's volatility right now. On one hand, you have high interest rates that's keeping some consumers away from buying vehicles, and you do have more availability, so maybe the pricing power isn't as strong. However, we have great jobs reports. Everybody's working. So I do think over time we'll see prices soften, but they're still near record levels, and you're just going to see kind of this up and down while automakers, including Tesla, struggle to find the sweet spot of what they can get from consumers while still keeping demand going.
Hey, David, thank you. Awesome as always. That stock is up by 3.5% about 4 minutes into this session. Another name to look at, Tyson Foods, reporting disappointing earnings, missing analyst estimates with falling meat prices squeezing the company's profits. The CEO said this: we faced some challenges in the first quarter. Market dynamics and some operational inefficiencies impacted our profitability. Kelly has more. Hey, Kaylee.
Yeah, Don, the stock down more than 5% in the first couple minutes of trading here. It missed by a relatively wide margin. Earnings per share coming in at 85 cents. The street was looking for $1.33. So that is a 36% gap between expectations and reality. And you had a top line miss as well, but that earnings figure is down 70% from a year ago. So where did the squeeze come from? Well, on the one hand, consumer demand for some proteins is softening and meat prices are going down. Chicken and pork sales growth volume both coming in lighter than expected. Pork sales actually down 7.4% year on year. And though beef sales volume did surprise to the upside, prices were down 8.5% versus last year. So you've got pricing problems and then expenses to contend with, including costs like animal feed, and tighter supplies of cattle and hogs mean livestock prices are higher too. All of that leading to narrower operating margins across those three categories, which is why overall operating margin of just 3.4% came in well short of sell-side estimates. All of this putting additional pressure on the stock this morning after already Tyson has been an underperformer within the staples sector. It's down 35% over the last year. The broader staples index down just 3%, John.
Down about 6% this morning. Katie, thank you. The broader market down by about 0.4%. Year to date, though, you know the story, flying. Before today, the Nasdaq 100 was still higher by 15% year to date. Note after note in the inbox this morning. Calls for caution. Strategists sounding the alarm after stocks surged to start the year. Morgan Stanley's Mike Wilson expecting the rally to reverse course, writing the following. While it may take a bit longer for the market to price our materially below consensus view on earnings, we remain convicted in our thesis. JP Morgan's Mislav Matejka echoing that view, recommending investors use strength to reduce exposure. And Goldman's David Kostin warning that the recent gains might be as good as it gets. TPW's Jay Pawlowski joins us now to discuss. Jay, wonderful to catch up with you, sir. Let's talk about those views we just got from JP Morgan, Morgan Stanley and Goldman and apply them to the US market before you and I talk China, EM and Europe. Are you on the same side as them when it comes to US equities?
Well, I mean, John, I think we have to acknowledge that several of those guys are stale bears, right? They've been bearish for a long time. They've missed this entire move. And so, you know, naturally, they're not going to capitulate now. I mean, I think our view for the S&P this year has always been kind of a flattish year, right? Plus or minus 5 or 10%, limited upside on earnings, starting point valuation quite high, you know, rates unlikely to go lower. We've never been believers in the recession, as you know very well. We've been soft landing believers. And so no surprise that when you get a jobs number like on Friday, immediately you have to price out the recession, which, let's remember, 5 weeks ago was the most anticipated recession ever. We wrote about that last week in narrative speed. So you've got to flip that script. No more recession, rates back up at the long end, dollar strengthens a little bit, and it's a perfect reason to take some profits on what, as you point out, has been, you know, like a serious rock and roll start to the year.
Well, Jay, let's talk about that rock and roll start. You were also looking for a major move away from big cap tech, and the Nasdaq just posted a 15% return year to date. What's in that? What's behind it?
Yeah, well, rates coming down sharply, right? Which was what was pricing in the recession. So we had a huge rally in bonds, which we were not believers in, did not really participate in. I mean, you're not going to get it all right, John, right? I mean, there's going to be a few things even guys like me miss. That's part of the game. So we didn't buy that recession impact on the long end, which supported the tech stocks. And now that stuff's being a little bit unwound. We think that tech is going to continue to be an anchor and a cap on the upside of the U.S. equity market. It's still 20+% of the S&P. And rates are not going lower, in our opinion, because we're not going to have a recession. And therefore, that caps the upside of big tech. And big tech caps the upside of the U.S. equity market on a relative basis.
Jay, one story you do like, it's Europe. It's down today, but year to date it's been flying. The move you've been looking for finally starting to develop. We're up by 10 or 11% on the Euro Stoxx 50. Euro dollar last week tested 110. It's back down to about 107. Jay, do you think a resurgent US dollar, if we get one, might be a challenge to your Europe call?
It would be, John, but I don't expect that we're going to get one, right? I mean, it's perfect. Again, things got very extended. So it's natural that you have, when you get an opportunity like Friday, things reverse a little bit. Dollar had been massively oversold. Now it gets a little bit of a bounce. I think the story of 2023, John, is the headwinds of 2022, inflation, rates, Fed, dollar, reverse to become the tailwinds of 2023. I believe we're on the cusp of a new global growth cycle. We have a desynchronized global economy. Asia is in growth mode. That's going to lead the rest of the world, and that's where the opportunity is. And Europe benefits from that. But to be honest, and I think we touched on this the last time we spoke a couple of weeks ago, maybe a month ago, I've switched. Our major geographic focus is Asia, particularly Japan and China.
Well, China's a big piece of this story. You mentioned China then, so let's pick up on it. Should you play China directly or through so-called China proxies, particularly, Jay, after the events of the last couple of days between the US and China?
I think that balloon story is such a laugher, John, right? I mean, I think it really is driven by folks here in the U.S. who do not want to see any kind of rapprochement between the U.S. and China. Secretary of State Blinken was due to meet President Xi. For the first time, a Secretary of State would get to meet Xi in 6 years. And that meeting was just postponed because of this huge brouhaha, which is a bunch of nothing. So yes, we're playing China directly. We believe China's made the move for growth. They understand the connection between stabilizing the property market, stimulating domestic consumption, and in that way driving economic growth. It's going to grow 6% this year. They have the fiscal and monetary policy room to support it.
Yeah.
Market very, very cheap. It's one of the cheapest stock markets in the world on a cyclical basis, according to Invesco. We're double weighted in our global multi-asset model portfolio.
Jay, your view or my view on whether that is a whole bunch of nothing over the weekend isn't relevant. It's about how everyone else sees it, Jay. And I know that it's been under-owned. And I know there's a positioning story where you could get these big flows. But, Jay, do you think the headlines we have seen over the last week are sufficient to make some people pull back? I mean, just bear in mind where sentiment was a year ago. We were talking about China being uninvestable. Is performance alone and positive performance sufficient to draw in inflows from underinvested American investors looking to China?
Yeah, that's a great question, John. And one of the reasons why we're so constructive on China and Japan is that we think it's not just the foreign investor, which we do think will buy into both markets as their growth recovery really gets underway. But more importantly, I would argue, is the domestic investor base, John. The domestic investor base in China is huge, and they're, I believe, going to switch from property focus to equity focus. And I think the same is true even more so in Japan, whereas yield curve control ends and the JGB market becomes a bear market. You're going to see for the first time in decades the domestic retail and institutional investor in Japan buying Japanese equities. It's a huge opportunity. Very few people are talking about it.
Jay, you and I promise are going to talk more often this year, I hope at least. It's great to catch up as always. Jay Pawlowski there of TPW. I've been teasing Jay for the best part of 2, 3, 4, maybe 5 years about Europe's underperformance, and finally he's getting what he wanted. Europe right now, a bit softer, but year to date flying. You know the story. On the S&P as well, the Nasdaq too. This morning we're down about 0.6% on the S&P. On the Nasdaq we're down 0.7. Coming up, tech layoffs piling up.
The labour market is in a good place. Maybe there's some distractions, from the avalanche of the tech sector layoffs, but the services sector clearly is doing really well.
Leslie Falconio of UBS, just around the corner.
Rates need to continue to rise. I think we need to acknowledge the labour market is in a good place. Maybe there's some distractions, from the avalanche of the tech sector layoffs, but the services sector clearly is doing really well. It's less about where headline rates go. It's about how long are they going to stay at a relatively high level. I think that's the second phase, which markets, need to be ready for. I don't think they want to price that in yet.
Let's talk about those tech layoffs. Dow joining the growing list of tech firms cutting jobs, slashing 5% of its global workforce. Here's the message from the C-suite. Market conditions continue to erode with an uncertain future. We now have to make additional decisions to prepare for the road ahead. Mandeep Singh joined us now from Bloomberg Intelligence. Mandeep, that's another name on a long, long list of names.
Well, so you have to look at, the different buckets. The Alphabet, Meta layoffs were more because their employee growth was faster than sales growth for the last 3 years. And I think their cost structure, everyone would argue, was bloated, just because of the hiring that they had done. In the case of layoffs, I think they've got yes, there is a PC downturn, but also inflationary pressures. And what I mean by that is, Dell is a company that's trying to relocate its supply chain from the China exposure they have to somewhere else. Same thing for wage pressures they have. So I think cost pressures for a company like Dell is much more pronounced than for, a Meta or an Alphabet.
Mandeep, this is a brilliant point. Uber later this week, they've got their own problems, haven't they?
Well, so, talking about cost structure, I think you have to argue that asset-light companies, why do a company like Uber have more than, 20,000 employees? And I think in that case, also you could make a point that even though the top line is diversified, why do they need so many employees? And I think the answer to that is, yes, some of it is because of the higher variable costs those businesses have. So compare, tech businesses like Meta or Alphabet, they don't have a lot of high variable expenses. It's high operating leverage. In the case of Uber, just because of the marketplace nature, they have higher variable expenses, and that will always imply, a lower gross margin than traditional tech companies.
Numbers from them coming Wednesday morning. I think, Mandeep, you and I will talk about it. I'm looking forward to it. Mandeep Singh there of Bloomberg Intelligence. So you've got the broader labour market and what's happening in tech. What's happening in tech, not great. The broader labour market, the jobs report on Friday, absolutely stunning. UBS's Leslie Falconio saying this: the payrolls report was a step in the wrong direction. The Fed will need to see more evidence that the labour market is softening before it considers pausing the rate hiking cycle. Leslie, I'm pleased to say, joined us right now. So Leslie, with that in mind, and thank you for being with us, where does that leave Chairman Powell tomorrow?
Well, I think it'll be interesting. I mean, I don't think he's necessarily going to take back some of his comments about allowing sort of this loosening financial conditions, overlay. But I do think that he will emphasize the fact that we have a strong labor market and disinflation, and that might sort of lengthen the runway out for his soft landing narrative. But I do think as well, he will also reiterate the fact that the pace may be slowing, but the higher for longer right now is still in place, particularly after Friday's number.
Leslie, if the jobs market is so strong, why aren't wages accelerating?
Well, I think it depends on, what type of wages we're looking at. I mean, wages such as, the ECI is still, it's coming down, but it's still well above the Fed's objective. And I think the important thing to look at is, the participation rate is rising. People are entering the labor force. But I do think there'll probably be most likely some revisions to this number. I mean, you've got warm weather, construction, there's seasonals, there's the strike being over. But even if a lower number comes out next month, it's really going to be hard to completely dismiss what we've seen. So I do think that overall it takes part of this, the Fed's going to ease at the second half, or at least the magnitude off the table.
Leslie, this market's responding, adjusting to what we got on Friday, regardless of whether we do get some kind of revision to the jobs number, the 2 years back through 440. As you look across the curve right now, Leslie, the 2-year, 10-year, that's about negative 80 basis points. Is there anything out of sync with what you're expecting to develop in the next coming quarters, coming months?
No, I mean, listen, the 2 years have been incredibly volatile, and I think that what's going on, and we saw this when retail sales became in below expectations. All of a sudden, the market was pricing in, 50, almost 75 basis points of easing at the end of 23, for a total of over 200 by the end of 24. Now it's starting to take that back a little bit as the terminal rate is moving higher. So now that we have the 2-year moving up as the terminal rate moves higher, I do think the yield curve is going to stay inverted around this area, say negative 80, at least for the first half of the year. After the Fed pauses, however, then I do think you're going to have this re-steepening of the 2s-10s curve. But by the end of the year, you're still going to be negative.
Leslie, I want to talk about credit too. We started the year, Rick Reeder and Mohamed El and I were going back on this on Friday. You started the year with this big fixed income breakfast buffet that everyone said had really juicy yields. And then about a month and a week into it, I'm not sure about those juicy yields anymore, Leslie.
Well, listen, when you have an environment where yields are coming down and vol is dropping, that's like carry heaven. So everyone likes to go for the carry trade. And I'm not saying that's necessarily the wrong trade, but the point being you don't need to go really down in credit to get that carry. So what we're looking at right now, and we've had tightening across the curve, but right now when we see spreads, both in below investment grade, say even triple C's, or even higher quality, whether it's, investment grade corporates, they're a little on the tighter side now. However, I do think you're going to have these small pockets of vulnerability, and then the higher quality will begin to tighten going forward. Because when you look at that carry today, what's generating that carry? It's treasury yields, not the risk premium. We've seen so much compression. We have spreads now back to where they were in April of 2022. So again, we like the higher quality. You might get short-term widening, but at the end, I think it'll be the better place to be as the year progresses.
Stunning rally to start the year already. Leslie, thank you. Leslie Falconio there of UBS on fixed income, credit, sovereigns going into Chairman Powell tomorrow. Bit of breaking news in the last 30 minutes or so. AMH down in DC with more. Hey, Anne-Marie.
Hey, Jonathan, that's right. The U.S. is weighing a 200% tariff on Russian aluminum. Traditionally, with the U.S. imports from Russia is about 10% of total imports. So this would effectively mean that it is banned. No one is going to be wanting to pay that price. This time, the administration has been deliberating for months, according to Jenny Leonard, a Bloomberg News reporter who scooped this story, Jonathan. And if you remember, this was likely a hard decision for this administration because in 2018, when the Trump administration had sanctioned Oleg Deripaska, he is the leader, main majority shareholder of NE+, which is a huge stake in Rusal. the market went bananas, and they probably wanted to avoid that. Maybe now they see is a time they can potentially get past that chaos.
AMH, thanks for that. Down in Washington, up next, your Trading Diary. We're 26 minutes into the session, equities lower by 0.6%. Let's get you to the Trading Diary. Coming up, Fed Chair Jay Powell speaks tomorrow, noon Eastern, in Washington. Plus, President Biden delivers the State of the Union address. Earnings from Uber, Disney on Wednesday, and a host of Fed speak with Williams, Cook, Barr, Bostic, Kashkari and Waller all on the agenda. Jobless claims on Thursday and the UMich Sentiment Survey to round out the week on Friday. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.